Hi, and welcome to Midas Investing. Today we're going to be taking a look at Mosaic, ticker MOS. Mosaic is a major producer of potassium and phosphorus-based fertilizers for the agricultural industry. And in fact, they make up 12 and 13% respectively of the total world supply of phosphate and potash production. I'm very excited to take a look at this company, especially with the major declines in its stock price recently. So let's take a look. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. All right, so hopping right into their Q4 presentation that they just released a few days ago. Right off the bat, you can see how they have their company split up into three main segments, that being the phosphate segment, their potash segment, as well as what they call Mosaic fertilizantes, which effectively makes up the Brazilian portion of their business for the other two segments. It's important to understand some of the differences between how these segments are being operated. Their phosphate segment, they operate in a more traditional, straightforward manner, while their potash segment, they actually are participating in a joint venture between many other potassium-based fertilizer producers in Canada and North America towards a venture called Campotex, where all of the total production of these companies for potash is all combined together, and then the sales of that particular venture being sold to international markets is then distributed to the companies based off of their total peaking capacity, which Mosaic ends up actually having a relatively large 36.5% share of that total capacity level. And then for Mosaic Fertilizantes, as I was saying, that is essentially their Brazilian presence, which is a pretty major market for fertilizers, as we'll get into. And they do a large amount of importing from their other two segments into this segment, and essentially importing the fertilizers and using it, as well as a significant portion of production being done directly in Brazil as well. So just important to understand the differences between here as we get into the model that I built for the company. Other things they talk about in this presentation, they talk about their capital allocation strategy, which they, in the last year, returned over $750 million in share repurchases, which made up about 3/4 of the 1 billion plus that they actually returned in total. So they have a decent dividend as well. I believe that on their 10K, they had another billion authorized for share repurchases. So it's perhaps reasonable to assume that we can expect similar returns going forward. And they seem to be implying that they intend to return virtually all cash flows to the shareholders. Combined with that, they also give outlooks for a variety of their expenses going forward, which is very useful in building up the model. That also coincides well with the analyst expectations in terms of how to generate the free cash flow expectations, which we'll get into when we get into the model. All right, so I want to take a moment to talk about the fertilizer industry as a whole and how that relates to the expansion of kind of the globalized world community. Here you can see the fertilizer production by nutrient type for the entire world going back to 1960. And right off the bat, it should be pretty obvious that the lion's share of fertilizer production is actually in the nitrate segment, not so much in the phosphate and potassium segments, which initially might give you some questions as to why it is that maybe we would want to focus on a company whose primary sources of their fertilizers comes from phosphates and potassium. And I'm going to make the case with some of these charts right here, how it is that with the growth of the usage of nitrates, that actually builds essentially a kind of permanent need for other fertilizers outside of just that one particular category. So even as this has become the more preferred type of fertilizer for the world, that you essentially can't really get rid of the usage of other fertilizers. And in fact, there's constantly looking to find other things that could be used as fertilizers even beyond these categories itself. So switching over to this chart here shows the globe by fertilizer use by capita as of 2019, which is not entirely super relevant to thinking about where the actual demand of things come from, but I think it's kind of useful to think about where potential demand could come from in the future. Because if you think about like what fertilizer use per capita would imply, it implies first of all that there's going to be a pretty significant level of GDP in each of these areas. Otherwise, they would not be able to use the fertilizer in the first place, and that's going to be relative to the GDP per capita, which is basically going to show just how much usage it's getting relative to each person in that space per dollar spent. And then also in terms of that, you have to think about what the lands of these areas are like naturally speaking, and how much fertilizer that's going to imply that they're going to need relative to that. So if you see, for example, the brightest and therefore highest level of fertilizer use per capita on this map ends up being places like Australia, New Zealand, and Canada, with also Poland seeming to be relatively bright there, and Brazil as well, and other sections of South America. Now, South America definitely has a lot of croplands going on in that area, but Canada, for example, obviously large sections of that there's not exactly the best of farmlands, though there's some good farmlands in the southern portion of Canada as well. Australia, not exactly the best of farmlands. So you can see like large levels of fertilizer use per capita doesn't necessarily drive it like where the demand is, but what it shows, one thing I want to show this chart for is that you can see how low that level is for places like say China and India, which have the largest growing population. So the fact that these fertilizer use per capita levels are so low, I think should indicate that there's actually likely going to be much higher levels of fertilizer needs going forward, just on that basis alone. All right, now if we switch from fertilizer use per capita to fertilizer use per hectare of arable land, which I think is actually a much more representative way to look at the information in terms of thinking about like where the actual demand for fertilizers is in general right now, and that actually does paint a different picture. As you can see, some of the brightest spots on the map are still relatively smaller countries, which it has largely to do with the scarcity of the arable land in those particular areas, but still the more middling relatively bright spaces end up being like places like Brazil, places like China, pretty much all of North America is painted relatively similar color. India is still appearing a little bit brighter, relatively speaking here. Interesting to see Egypt's so bright there, though relative to some of the fertile lands that exist there, that's perhaps not too unexpected. But what this does paint is actually a good picture of where the demand currently comes from, because places like Brazil and China and the United States do actually make up some of the highest levels of fertilizer use around the globe currently. And then we can break that down by the different categories of the fertilizers we were talking about here, being nitrate inputs per hectare of cropland. Interesting to see the Middle East is so heavily reliant on nitrates, and Japan as well, but still showing China as well as the US, and decently so for Brazil, but maybe not as much for Brazil in the nitrate category. Which is something that we should definitely note relative to, as I was saying, the high level of Brazilian exposure that Mosaic has. And then if we switch over to phosphate fertilizer use, boom, lo and behold, as I was just calling your attention to the Brazilian usage, you can see here ends up being the strongest place, pretty much globally, for phosphate use per hectare of land. That ends up being the more preferred fertilizer in Brazil in particular, which relates somewhat to the way in which the fertilizantes segment is arranged in that particular region. Switching over to potash, you can see that trend also continues, which makes sense again, while relative to the high levels of imports that Mosaic does into Brazil. Still showing high levels of demand levels coming from China and the US as well. All right, so these next two charts are the charts that I think really paint the picture for me as to why it is I'm not overly concerned with the seeming preference for nitrate-based fertilizers. Here you can see over the last 120 years, the growth of the world population. And here it shows it's segmented out by population supported without synthetic nitrogen fertilizers versus population being fed by the synthetic nitrogen fertilizers. We were seeing the pretty bright spots on the map of the nitrate using areas, and how that relates to possibly the largest growth of the populations over the last decade, which goes to show that there's a huge amount of reliance on those nitrogens, which at first this might seem to paint the picture of, like I was saying, why maybe nitrate would be the more preferred segment to be in. And the truth is that you can't necessarily use all types of fertilizers indefinitely, because the effective usefulness and the amount of yields you get out of them starts to diminish, which is shown by this graph right here. This graph, which really kind of painted the picture for me, shows the over applying of nitrogen, which they measure by essentially measuring how much nitrate is left in the crop soil after you've already gotten the crops out of it. And then they compare that with the change in the yields that the country has gotten over a specific period of time. And so what that shows us is that the brightest spots on the map is the places that have used nitrate the most and have essentially not gotten the results that they otherwise might have wanted from the nitrates. So China obviously being the big one that really stands out on the map here. That seems to indicate to me that perhaps at some point or another, China will be somewhat forced to switch their horse in terms of thinking about which was the more preferred fertilizer for them. And obviously Brazil, still being a relatively bright spot on the map, definitely paints the picture pretty good for Mosaic's presence there in both the potassium and the phosphate-based fertilizers. All right, so let's hop into the spreadsheet and take a look at some of the company data that I put together into some charts of my own to kind of paint a picture a little bit of how their operations work. Here we have 3 different charts giving you an idea of the distribution of their volumes, revenues, and margins across the different segments. Normally, I like to show one chart at a time, but I figured showing these 3 charts all together actually makes a pretty big difference to the understanding of what's going on here. So here you can see their sales volumes by tonnage across the three segments with, you can see in general, they're pretty close to even. The fertilizantes one is a little bit larger, making it close to like 35%, whereas the other ones are a little bit closer just to 30%, but still relatively even and relatively even across the years in terms of the total tonnage that they actually sell. But then if we switch into revenues in particular, then the Brazilian fertilizantes then really starts to take up more of a solid lion's share. The actual percentage end up being close to 40%, while as the potash segment ends up being a little bit of a smaller segment, making up 20 to 25%, with phosphates making up the rest there. So pretty interesting to see that, especially given, like I said, the different dynamics that exist between these segments. The Brazilian one is very much focused entirely on Brazil, and then the potash segment, it does sell domestically and internationally, but as I was explaining the relationship for their international sales with Campotex, which does actually make up almost half of the revenues within the potash segment. International chunks of the revenues make up closer to more like a third or a quarter of the revenues for the other segments, but it makes up almost half of the revenues for the potash segment, which makes sense given the relationship with Campotex. So they have a smaller portion of the revenues, but that's because the potash segment is largely focused on that exporting feature, which then relates into, as I was saying, the large amounts of imports of fertilizantes, because a decent amount of the revenues for the potash segment is going to be related to the Brazilian operations. And then if we switch to the gross margins by segment, that I think shows this difference even further, showing that the vast majority of the gross margins comes from this potash Campotex relationship. Showing that I think by having the larger levels of the peaking capacity, that gives them the largest share of the revenues there. I think that also improves their overall profitability because of the relationships they have with the other companies in that area, and the larger reliance on it being shipped outward, likely a huge portion of it to their own player. Interesting to see, for example, the smaller gross margins is also in the Brazilian fertilizantes segment itself. You can kind of think of this like a lot of people would look at a segment that has high revenues and low margins, say like, oh, we should do less of this business and we should do more of this business. Well, they're interrelated. In fact, I only think that they get the margins that they get on this segment here partially because they have the other business there. So I think by having it split this way, in a way where a larger portion of your revenues comes from this segment, a larger portion of your margin comes from this segment, I think they sort of, those things are tied together, and it's actually sort of a competitive advantage, in my opinion, for the company. All right, now switching over to this chart right here, which is that's a little bit of a lot going on in it. Here I have essentially put together all of the commodity prices that are going to be related to building up for the model for the company. That includes both the output selling prices that they're using for their phosphates, their potash, and the fertilizantes segment, but that also includes the input costs that they give us, because they actually give us quite a lot of detail in terms of their input costs for their phosphates and other fertilizers, which are heavily reliant on natural gas, ammonia, sulfur, as well as the base phosphate rock that goes into the material. So they give us a decent amount of information in terms of how to determine the pricing over time for each of these. And I put them all into one chart, mostly just to kind of paint a picture. It's not so much about the specific price here, is more just trying to paint the picture of the overall price trends, which is to say that they're following very similar price trends to the majority of commodities over the last several years, where there was a pretty solid, consistent trading pattern for many years on average. Moving into 2020, there was actually a decent amount of commodity price deflation, at least to a moderate level for quite a lot of commodities due to the decrease in demand caused by the shutdowns. And then a huge spike up in pricings as we came up out of the lockdowns and all the supply chain issues we were having, as well as all of the monetary changes that were going on through that, and then a decrease in all the commodity prices in 2023 as all of the monetary tightening has started to move back into place, as well as a lot of the supply disruptions have started to alleviate. So in this valuation, I'm largely going to be trying to separate out the value of the company from the from the actual commodity prices. We're not really trying to make commodity price assumptions about what's going to happen in this company. And the way in which I'm going to be keeping these things consistent is by essentially keeping the relationship between the output prices and the input prices relatively even. We're largely going to be assuming that the prices are going to remain in sort of a trading pattern somewhere between the average of where they were previously and the peak levels that they reach. So we're assuming largely that all these commodities are not going to reach new peak levels, but they are essentially going to stay at some middling level that's decently higher, probably 20 to 40% higher, depending on the commodity, relative to the averages we saw in 2019 and before. All right, now let's take a look at each of the individual segments a little bit. Here, taking a look at the phosphate segment first. Here with the blue area background is the total revenues of the phosphate segment, with the red background being the COGS of the segment. And you can see in general, it has a pretty thin gross margin overall, which is, as we were seeing on the previous gross margin charts I was sharing before, and they even had negative gross margins for 1 year in 2019, which created that kink in the 100% stacked area chart that I was showing previously, with some higher gross margins during the years where we were having high levels of inflation, and then those gross margins have dropped back pretty significantly. In the green line is the COGS as a percentage of revenues. That's not gross margins, it's the COGS costs as a percentage of the revenues, which in general on average has been around 85% on average over the last 10 years. So in general, we're going to be assuming that relationships like that are going to be mean reverting in general. And then the orange line, what I included here, is actually an estimate of the material cost as a percentage of the COGS. As I was saying before, they include a decent amount of information related to their input costs, and that includes an approximate average recipe, so to speak, for each of the materials as it goes into, essentially like how much of this material per tonnage of the phosphates do you use. And so I've made an estimate for as many years as I could, going backwards to 2017, of the material cost, which is what the yellow area is down here, and then this orange line is the material cost as a percentage of the COGS. So I said on 85% on average is the COGS here, and you can see it's maybe about 50% on average is the material cost, which means that about 40 to 45% of the revenues is the material cost. The reason why I'm trying to separate these two things out is because the material cost is going to be related to those commodity price changes. And as I was saying, I'm going to be keeping the input costs as consistent as I can with the output costs to try to keep the profitability relationships reasonably consistent over time. And then the remainder of that ends up essentially being labor costs and overhead costs, effectively speaking. Switching over to the potash segment, we have roughly similar information. For the blue areas, it's the revenues, and then the orange is the COGS. Unfortunately for the potash segment, due to the relationship it has with the international the venture of Campotex, they don't really give the same input cost information, and that's just because of the way all of the revenues are contributed together. But I do still at least have the COGS as a percentage of the revenues, which you can see in general has been about 65 to 70%, depending on how much you want to include the lower periods of costs we had 21, 2022, but maybe 65% on average, 70% in some of the higher levels going backwards. And then switching over to the fertilizantes segment, we have the same information that we at least had for the phosphate segment here. Here you can see the revenues in the blue background with the COGS as that, and very interesting to see those razor thin gross margins that we've had in general across all of these years. Even in 2021 and 2022, the overall margin didn't really grow by as much as some of the other segments, and it's come back down pretty significantly as well. Also interesting to see that with the estimate of material costs that they give us here, it makes up a much larger percentage of the overall business going on in this particular segment, which I think is very interesting. I think that's largely because of the fact that they have to import it, a significant portion of those imports, and it comes from the other segment. So essentially the costs of this segment ends up being the revenues and the profits of another segment, so to speak. But I also found that very interesting because, as I was saying before, the remainder between the material costs and the overall COGS would imply the overhead and the labor costs. And I don't have a chart showing this information, but in the 10K, it's a huge disproportionate amount of their employees are Brazilian employees. So it's very interesting to see that even though they have a huge amount of employees in Brazil, that labor cost doesn't even seem to make that big of a dent overall in the overall cost here. And I think that's largely because of the labor being used there is much more of about like a sales and marketing type position than it is as much about production. As I said, they do production in Brazil as well. It's just not as much as in, say, the phosphate segment. But then likewise, we have the COGS as a percentage of the sales, which here you can see in general has been like 90 to 95%. across all of these years. And then the materials as a percentage of COGS, which, as I was saying, it really itself makes up like 90 to 95%, even more than 100%, or about 100% in some of the years. All right, now hopping in to take a look at the model that I built for the company. I'm not going to go through every line that I put together for this model because honestly, it's a bit of a complex model considering all of the input and output costs, as I was saying, as well as the different segments that go into it, and a few of the other kind of assumptions that I kind of had to do to come up with some of the numbers here. So I'm definitely not going to give every single line item and explain exactly every assumption that I made, as I've done with some of my valuations. But I'm going to try to give at least some of the core information I think that paints a picture of like how this model was generally put together. First off the bat, as I often have at the top here, some just general macro information that I think is related. I do have the global population going back for the last several years. As we're saying, the global population is going to be a huge driver of the demand for fertilizer growth going forward. And in general, we are expecting about a compounded little bit less than 1% growth in population per year for the next decade, getting us up to about 8.7 billion humans here on this planet in the next decade or so. So, you know, we should see some fertilizer growth based off of that, though it obviously has to do with the distribution between the different types of fertilizer usage, as we were talking about with those other charts. So firstly, getting into the phosphate segment, the phosphate segment was actually split up into two different sub-segments, of that being finished products as well as the phosphate rock being sold as a commodity itself. The selling the rock is a relatively small portion of their business, but since the prices that they get for the phosphate rock itself was significantly different, I did choose to keep that different. In terms of thinking about the overall production levels and how that relates to the sales volumes that they're going to get, in general, we're assuming that the averages that they've had over the last decade is largely going to continue moving forward. So for the North American production volumes of the phosphate segment, they had about 8.3 million tons over the last decade or so. And in general, we're going to be assuming that going forward. I'm actually assuming a little bit less in this particular segment, which you can see in general on average across the three outcomes. I actually have 7.7, and that's because you can see that there is actually a moderate downward trend in the North America production for phosphates, which somewhat makes sense if you actually compare this with their mineral reserves and resource levels in the three segments, because the phosphates North America has the smallest amount of those reserves. So in a sense, they're moving towards the curtailment of those operations in those areas, which is going to relate actually to another detail that I'm going to talk about after I get through this model as well. But then in the actual rock level volumes, those themselves will probably remain much more consistent, because those I've actually been going for less amount of years, and as I said, those require less total inputs, because essentially you're just selling the phosphate rock and you don't require all of the other input costs in order to sell it, which is part of the reason it's cheaper in the first place. So this particular portion of the phosphate segment will likely remain a little bit more consistent at about 1.3 million tonnage on average going forward. And then, as I had said before, pretty much all the price assumptions, we're going to be assuming that it's going to be less than the peak levels. In the bull case, it's going to be less than the peak levels that they had in 2022, but in the bear case, it's probably going to be higher than whatever the average was of the last 10 years, and perhaps even a little bit higher than whatever the most recent price was in 2023. That applies pretty much across all of the segments, with pretty much no exceptions across the board. As I said before, they do give some basic information, essentially recipe, so to speak, for how the ammonia, sulfur, and rock input costs relate to the total material cost for the COGS. So I put that together, and I end up with assumptions across my three models of about 2.6 billion 10 years from now, across bare, base, and bull cases for the estimated material costs, which, as I was saying, is likely to make up approximately 56-57% of the COGS. So with that, we can then extrapolate upward to COGS assumptions of about 4.5-4.6 billion, which itself ends up being about 78% of the revenue. So then if we can work backwards with that, that gets us to our profitability for the segment. All in with the production levels and the prices, we end up believing that the phosphate segment itself is going to do about 5.8 billion across the three models, anywhere from 8.4 billion in the bull case to almost 3.5 billion in the bear case. And with that, we can move on to the potash segment. The potash segment, as I said, we don't get the same level of input cost details, so I can't quite get the same level of information for the profitability there. So in terms of thinking about like how the profitability is going to work, we're really just going to be relying on the longer term average of the COGS for that and moving forward. And likewise with the phosphate segment, we're going to be assuming that the volumes that they're selling is going to be relatively consistent. Now we don't see the downward trend in this particular segment that we saw with the phosphate segment, so we are going to assume it's a little bit more consistent at approximately 8.2 million tons in 2023, which is pretty close to the average that they had over the last 10 years going forward, which is consistent with the resources that we see for this particular segment, which is a lot to say the mineral reserves and resources across the potash and the Brazilian fertilizante segments as many decades, if not hundreds of years worth of fertilizers, depending on the price levels and economic conditions in those particular decades, of course. So coming down to the fertilizante segment, likewise, we're assuming that the sales volume are going to remain relatively consistent. On general, those have actually been moving upward over time. Over the last 10 years, there's actually been a large growth in the total sales volumes in Brazil. So us assuming that the sales volumes for this segment is going to remain consistent is actually probably a reasonably conservative choice for this particular segment. But considering it is in the international markets, and there's also, like I said, the uncertainties about which particular types of fertilizer to be using, I feel reasonably comfortable having a pretty major conservative detail like that in here. Pricing levels remaining consistent as we were talking about, using the same extrapolations for the material costs using the ammonia, sulfur, and rock inputs that they gave us. That gets us up to assumptions of about 5.7, 5.8 billion in estimated material costs, which we would expect to be approximately 87% of the total COGS, which then therefore implies total COGS of about 6.4, 6.5 billion. And that's compared to the expected revenues across the cases of around 7 billion, with bear case of around 5 billion and bull case of north of 9 billion. So all in, those revenues combined together gets us a bear case of a little bit less than 12 billion, a bull case of a little bit less than 23 billion, and a base case of about 16.7 billion for 2033 revenues. The total COGS all in together across the board ends up becoming, on average across the models, about 82% of the sales. Which gets us an implied gross margin of around 18%. And then likewise, we're mean reverting across the last decade for our SG&A costs, our other operating expenses, as well as restructuring costs, because they did have some decent restructuring and other costs in there, which some people might not even include in here and say, oh, those are just one-off type expenses. But I'm going to assume that they're likely going to have some of those going forward under most circumstances. And so we'll actually include those to curtail some of the higher levels of profitability in our bull case. All in together, that gets us to operating income of a little bit less than 800 million in our bear case, and a little bit less than 3.4 billion in our bull case, a little bit less than 1.8 billion in the base case, which equates to 6.7% operating margin in the bear case, 14.8% in the bull case, and 10.7% in the base case. All right, now there's one other interesting thing that I wanted to add on to the valuation here. This is something that I don't usually do with a lot of valuations, which is to say, add other assets that are not being used for their operations. They report in their 10K that they have significant land holdings in Florida, as well as in Brazil and Peru and other places. I'm primarily focused on the Florida land holdings, particularly because I understand how a lot of the legal proceedings work in the United States, and also they give a lot of information in a few of their annual reports that I think makes it worthwhile to consider this as an extra value to the company. As of the most recent 10K, they currently have 368,000 acres of land in Florida. Now, keep in mind, a lot of this land is lands in areas where they have their resources, also where they've had have their operations, where they've had previous operations, and also areas where they've been reclaiming some of the land post the ending of their operations. And this is relevant because, for example, in the last 10K, they talk about this as well. They talk about this in pretty much all their 10Ks. But it's worth noting that in the last year, the amount of land that they've had has increased, but that's not really the point of going back to the 1 year, which is to say that 1 year ago, they were talking about how they had sold 7,000 acres of their land with a resort that they had built on it, which had then gotten them a $160 million overall gain in there. Well, I shouldn't say gain, but because they have to take out the cost relative to that, but they sold it for $160 million. So I was thinking about this and realizing this is like, one, they have so much mineral reserves and resources that they have far more than they actually need for the company to operate into perpetuity. As I was saying, they have decades, if not potentially over a century worth of resources, depending on the economic conditions. So effectively speaking, that means to me that they could sell huge portions of the land holdings they have and not actually affect their operations at all, because they have much, much more resources than they actually need in order to do their operations. Now, obviously, they're not necessarily going to get this pricing on every piece of land. Some land is better than others, and they're probably going to sell the better land before they sell the worst land. And they have to reclaim the land, as I was talking about. They have to build resorts in order to make it worthwhile. So this doesn't say anything about the profitability. So we have to be very conservative in how we choose to add this value to the valuation. Now, I wanted to point out to you that the 160 million divided by 7,000 implies about $22,000 per acre in terms of the sales price they got. Now, I went and I took a look and I was curious. I was say, okay, what is the average acre of land cost in Florida? And according to this article I found on Zippia, it was, as of a year ago, about $35,000. So if we assume that maybe, like I said, maybe a lot of it's going to be bad land, we assume perhaps about half that price, just to random kind of spitball number on that. And then we also perhaps assume a pretty typical profit margin for real estate development, which according to my data set over the last 8 years has averaged about 5% on average. And we apply that 5% profit margin to all of the land approximately at half that pricing. And then we also assume that this is not going to be something that we get to capitalize on in the near term. It's something that perhaps is on in the perpetuity. And so we then discount it back by 10 years at the cost of capital, which is essentially what I did. I ended up finding about a present value for that land of about $190 million. Now, you could argue with a lot of the assumptions that I included in there, but I think you could also argue reasonably to the upside in that form as well. It's worth noting that $100 million divided by those total amount of acres implies a current present value being applied to the valuation of really about $1,200 per acre. So I think that's reasonably conservative relative to, as I was saying, the $22,000 that they managed to actually generate profit out of in the most recent year. So I did add this extra $190 million onto the valuation. So when you're looking at the value that I'm about to spit out with my DCF template, it's worth noting that that really ends up being like an extra 2% on the value. So if you don't really feel comfortable with adding that extra land value on there, you can essentially just discount my value by about 2% to effectively take it out of there. All right, so now coming over to take a look at the DCF template with all of the assumptions that we came up with our model and put into it. As we typically do with revenues, we're relying on analyst expectations in the short run for the first 2 to 3 years. So we are expecting them to decline the revenues by about 10% in this particular year, and then probably to be relatively flat for the next 2 years after that before starting to have their growth at that point thereafter. Though there is obviously a decent disbursement between the bull case and the bear case, as we were saying, in the terminal year, anywhere between 22,000 and 12,000. So a pretty wide range of potential outcomes that we're really seeing for the growth cases right here. But the point is, it's definitely likely to remain relatively solid in the total revenue growth before potentially taking off in the overall expected case. And then likewise with the operating income assumptions, the analysts are expecting to have relatively higher operating margins compared to at least our assumptions for the terminal year in the short run, which we are at least being a little bit more conservative with the analysts, as we typically do in the short run. But then we see it moving towards our terminal assumptions as well on the expected case of about 10.6%. Going down here, you can see how those operating margins move over time in this particular chart. Operating income quartiles here, and then the terminal year operating income distribution, with most of the outcomes bunched up between about 1 billion and 3 billion or so. And then coming over to capital investments and free cash flows. In the short run, our free cash flows are definitely going to be a little bit more conservative than the analyst expectations, but we also like to adjust our expectations for things like stock compensation that they're not included there as well. But either way, being a little bit more conservative in the short run, a little bit less than a billion per year, which is kind of closer to where the analyst number is, and then moving towards the terminal year based off of relatively mild reinvestments in the terminal year. Much of the reinvestments we're expecting them to have really is more in the short run. Coming down here, you can see that on this particular slide right here, large levels of net reinvestment and then moving towards more of a terminal level. Overall returns on invested capital, we're expecting it to be relatively moderate, single digits, which is, not impressive, but that is kind of what you would typically expect of more commodity companies in the first place. So that's pretty appropriate. And then the free cash flow distribution, we see most of the outcomes bunched up between about 750 million and 1.5 billion. All right, and then coming over, take a look at the discount and terminal assumptions. The cost of capital and the growth rates that I have applied to the valuation gets us an implied terminal multiple on average of about a 12, which is pretty consistent with the interest rate adjusted comp groups that I was looking at in general. Overall excess returns being close to zero, which again, very typical of a commodity company. So it's about what you expect. With the valuations we come up with, the first quartile end up being a little bit less than $28 per share, and third quartile about $47 per share. So we would expect about 50% of outcomes to fall between those prices on an expected basis, about $38 per share. Here you can see the fair value distribution as well as the expected returns distribution for the next 10 years. And then with that, you can come over and see the final summary page showing all of the expected cases for each of those values. And then coming down here, it's currently trading at $31.52, which we find to be at about the 34th percentile of the valuation distribution that we created. So about 2 times as many outcomes that we can conceive of is above the current price as is below it. Current expected value, again, being a little bit less than $38 per share, 20% of upside. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for Mosaic, ticker MOS. I did actually take a position in Mosaic relatively quickly before I managed to get this model fully put together, partially off of the basis of finding a lot of pricing against comparables to be very attractive and very appealing, and also because I was somewhat interested in the fertilizer space, which is part of the reason that I built this model in the first place. But point is it's definitely beyond the point of me really wanting to add to it here, but it's also very possible that it could start to retrace back, and who knows, maybe we'll be adding some more to it back in the 20s at some point in the near future. So that's going to do it for this one. I'll catch you all in the next valuation.